Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. The Federal Reserve's May pause is the catalyst reshaping portfolios right now. Markets are pricing in 2 rate cuts ahead, and that expectation is driving sector rotation, bond positioning, and risk asset flows across equities, fixed income, and crypto. The Fed is holding rates steady in a target range between 3.5 and 3.75% after cutting 25 basis points back in December 2025. The pause isn't in inaction. It's strategic positioning with forward guidance, signaling flexibility for cuts based on labor market data and growth indicators. According to J.P. Morgan Global Research, market projections anticipated that the Fed would hold rates in the 3.50% 3.75% range through 2026, with the next move expected to be a 25 basis point increase in the third quarter of 2027. That's the setup. 2 cuts in the near term is the base case traders are working with. The question for June trades is how to position across asset classes before confirmation hits. Start with equities. Lower borrowing costs compress discount rates and valuation models, making future cash flows more valuable today. That math favors growth stocks hard. Technology names that burn capital for expansion suddenly look cheaper. Software companies with high growth multiples, biotech firms funding research pipelines, emerging platforms scaling infrastructure. These sectors get re-rated higher when rates drop. The key ETFs under watch are SPY for broad market exposure, QQQ for NASDAQ tech concentration, and IWM for small-cap cyclicals that benefit from cheaper financing. According to Ticker-On analysis from June 2025, these instruments saw surges driven by AI-driven trading and shifting macro conditions. That pattern is setting up again. Sector rotation is the trade right now. Growth and cyclicals are pulling capital away from defensive sectors that outperformed during the tightening cycle. Financials present a mixed bag. Banks face net interest margin compression when rates fall, but lending volume could increase if economic conditions improve and credit risk drops. Real estate gets a direct boost. Lower mortgage rates stimulate housing activity, commercial real estate investment picks up, and REITs see performance improvement as financing costs decline. The bond market is where the nuance lives. Treasury yields have been volatile. The 10-year spiked near 4.5% during periods of inflation, concern, and geopolitical uncertainty, as reported by Yahoo Finance. Now, with 2 cuts priced in, short-term yields are expected to decline faster than long-dated bonds. That steepens the yield curve. For fixed income traders, duration strategy matters more than ever. According to BlackRock research on rate cut portfolio implications, intermediate duration bonds with maturities typically less than 10 years offer superior risk-reward in a shallow-cut environment compared to long-dated treasuries. The logic is simple. Short-term yields drop with Fed cuts. Long-term yields reflect inflation expectations and growth outlook, which don't necessarily fall proportionally. Schwab's 2026 fixed income outlook reinforces this positioning, emphasizing the value of staying intermediate rather than extending duration aggressively. Charles Schwab analysis points to the risk of bond market turmoil if inflation worries persist. Crypto Briefing reported that U.S. bond market turmoil raised doubts over Fed rate cuts in 2026 during earlier volatility spikes. That risk hasn't disappeared. If economic data stays hot, cuts get delayed. If data weakens significantly, cuts could accelerate beyond 2. The bond market is telegraphing probabilities in real time through yield movements. Cryptocurrency markets are positioning for a risk-on environment. Lower yields on traditional safe assets reduce the opportunity cost of holding non-yielding assets like Bitcoin and Ethereum. According to a Clear Street executive quoted by CoinMarketCap, Fed rate cuts in 2026 will drive retail crypto return. The thesis is straightforward. When Treasury yields compress and money market rates fall, speculative capital hunts yield and growth elsewhere. Crypto benefits from that flow, especially if risk sentiment improves broadly across equities. The correlation between crypto and risk assets has tightened. Bitcoin doesn't trade as digital gold in isolation anymore. It moves with tech stocks, leveraged to liquidity conditions and growth expectations. Two rate cuts reinvigorate that dynamic. Retail demand increases when safe assets yield less and narratives around innovation and disruption regain momentum. Volatility is the wild card. The VIX is under scrutiny as traders assess Fed policy timing. The pause itself removes some uncertainty around immediate policy shifts, but the prospect of cuts introduces new volatility around timing and magnitude. Key support and resistance levels across SPY, QQQ, and IWM are being tested. Round number psychological levels, previously tested resistance zones, and high-volume trading areas from recent sessions are the technical markers that matter for June entries and exits. Economic data dependencies are critical. The Federal Reserve's decisions hinge on labor market indicators, including employment growth, unemployment levels, labor force participation, and wage growth trends. Inflation measures remain front and center. Consumer price index readings, personal consumption expenditures data, core inflation trends, and the services versus goods price pressure split all feed into the Fed's framework. Growth indicators like GDP, consumer spending, business investment, and manufacturing activity round out the dashboard. Market-based probability indicators show modest confidence in cuts occurring before or by early June 2026. That's not certainty. It's a probability distribution that shifts with every data release. The base case is two cuts implemented gradually as economic data softens. Alternative scenarios include accelerated cutting if the labor market weakens significantly, delayed cuts if inflation pressures persist, or no cuts at all if growth stays robust. According to Federal Reserve meeting minutes, the committee is emphasizing data dependence and flexibility. That language keeps options open but provides little concrete commitment. For traders, that means positioning for the base case while hedging tail risks. If you're long growth equities anticipating lower rates, consider how positions perform if cuts get delayed. If you're extending duration in bonds, assess how a steeper curve impacts returns if long-end yields don't cooperate. The global rate environment adds complexity. The Fed doesn't operate in isolation. Central bank policies globally affect currency exchange rates, international capital flows, emerging market debt dynamics, and trade financing costs. A Fed cutting cycle while other central banks hold steady or tighten creates cross-border capital movements that ripple through equity and bond markets. Technology sector plays are the most direct beneficiaries. Lower cost of capital for growth companies makes software, biotech, and emerging tech platforms more attractive. Financial sector positioning requires selectivity. Banks face margin pressure but potential volume gains. Real estate benefits across housing and commercial segments as financing costs drop and investment activity increases. The iShares analysis on what Fed rate cuts may mean for portfolios highlights the importance of rebalancing ahead of policy shifts rather than reacting after the fact. June is the window to position before confirmation arrives. Once the first cut is official, much of the move is priced in. The edge comes from anticipating the shift and structuring exposure accordingly. U.S. Bank insights on how changing interest rates affect bonds emphasize inverse price-yield relationships. When yields fall, bond prices rise. That's the gain opportunity in fixed income if you position before cuts arrive. But duration risk cuts both ways. If cuts don't materialize or inflation reaccelerates, those positions suffer. Bank rates analysis on how the Fed impacts stocks, bonds, crypto, and other investments frames the interconnectedness of asset classes under shifting monetary policy. Lower rates don't just boost one sector, they reshape the entire risk-return landscape, reallocating capital from cash and short-term instruments into equities, longer duration bonds, and alternative assets like crypto. The macro setup is clear. The Fed paused in May with forward guidance suggesting two cuts ahead based on data. Markets are pricing that scenario. The actionable question for June trades is where to deploy capital to capture the move while managing the risk that the scenario doesn't play out as expected. Growth equities, intermediate duration bonds, and selective crypto exposure form the core of a rate cut positioning strategy. Volatility hedges and technical discipline on key levels protect against surprises. The coming weeks are critical. Economic data releases will validate or challenge the two-cut thesis. Labor market reports, CPI prints, and GDP revisions are the catalysts that confirm timing. Position for the base case, monitor data dependencies, and stay nimble as probabilities shift. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.